how does the mortgage process work for somebody that was looking for an investment property or a second home?
Well, the process really isn't that much different. Now, keep in mind, the only types of loans that are available for second homes or investment property are conventional loans or alternative non-QM, quality mortgage type products like a bank statement or DSCR. But let's just keep it simple and leave it as a standard purchase or refinance for second home or investment property. So a second home, the process for documents is ultimately the same as anything else. However, you're going to have to qualify for your primary residence and the second home. So you have two mortgages to qualify, assuming you have a mortgage on one of your other properties. So your down payment requirement minimum is 10%. You can't do 3 or 5% down on a second home. Minimum 10%, but that is available. Interest rates changed back a number of years ago on second homes. They used to be quite similar to primary residence, but people were buying investment properties and calling them second homes. Fannie and Freddie got wind of it and they said, okay, I can't beat you, so I'll join you. And everybody pays investment prices, even if it's second home. So that's how all the prices went up on second homes. Investment properties, again, conventional loans only or alternative type financing, 20% down minimum. There actually is a 15% down investment program through Fannie Mae, but you have to have PMI, and the PMI is almost as great as the additional 5% that you would need to put down. So don't do that. It's not going to make a lot of sense. Put the 20. Now, I encourage investors to put down 25 to 30 because it will improve their interest rate and closing costs. So Fannie Mae does what's called risk-based pricing. So we talked in earlier segments, how does your interest rate or how does your credit score affect your interest rate? Everything affects it. So the more you put down, the lower your potential interest rate could be.
Makes sense.
Until you get to too low of a loan amount, and then it can start going up again. So there's sweet spots in there. But investment, you have to keep in mind, you're going to need a bigger down payment, and you have to have cash reserves for every rental property that you own, up to 6 times the monthly payment for each property. So oftentimes people can afford to buy investment properties, but do they have the reserves?
They can't show the reserve.
So those are things that you have to be aware of. And those are the things that we look for. But the process, Chris, is quite similar for anything. You're documenting the same basic types of things, but your interest rate's going to be higher on investment than it will on primary as well. So keep those things in mind.
Now, if they were to qualify for, like, if it's an investment property and they were going to rent it out, could they, if they have a tenant in place, could they use the lease money for that tenant to offset having to have those reserves?
Not only can you do that, I can even use one where you don't even have a tenant in place yet.
And do a possible or potential
so what
tenant?
we would do is you have the appraiser do what's called a gross rent multiplier. They do it on their appraisal. They usually charge a couple $100, $150 more to do it, but they do an analysis based on what the rents would be in that area for that type of property. And then I can use 75% of that to offset your payment.
Ooh, I like it.
All right. So those are types of things. We have a lot of future videos to do in here, and a lot of different segments. We want to dive deep into loan products and other scenarios. So if you're watching these videos, contact Chris and I. Let us know questions you may have that we can answer for you. We want to make sure that all of our clients are fully informed of everything that we do and how you can navigate and get the best out of your next real estate transaction.
Yep, that sounds good to me.
All right. We'll see you next time, Chris.
See ya.